Hello, everybody. Welcome back to Built for Life, Not Just Wealth. My name is Ryan Burklo.
And I'm Alex Collins.
On today's episode, we're going to be talking about something that I think is hard not to do. And that is when everyone has an opinion of the stock market, who in the world do you listen to and what do you do about it?
Right.
And this stemmed from yesterday was February 1st. It was a Sunday. And I was on Twitter and I saw everything
Well, I mean,
from
there's your first problem.
it's on all social media platforms. I actually
Again,
like Twitter.
there's your problem.
So no, fair, right? But it's hard not to see it because it's thrown in our face. And it was
For
everything
sure.
from like today was going to be like the 1987 crash to this is where we have the biggest bull run ever, like the 90s.
Yep.
And the fact of the matter is, no one actually knows. They're all guessing.
100%. Like market timing does not work. Period. It's time in the market, not trying to time the market. And that's that's something that's talked about a lot in the industry. It's something that financial advisors say a lot. It is somewhat self-serving to say it, but at the same time, it's also true and accurate. How do I know? Because we're allowed to say it.
Yep.
I mean, it's trying to predict the market is a fool's errand.
Look, and I've said this line before, so it's not going to be new, but the fact of the matter is if anyone could predict the market with any kind of consistency, there'd be a statue of them on Wall Street and not the bull.
100%.
The fact is predictions, right? This is all trying to get your eyeballs. This is all trying to get your clicks. This is all trying to get you hovering over it, like all of the algorithms inside of social media. Because let's just call it what it is. We want certainty as a human being. And so we're trying to find the person that can give us any sense of certainty or at least sense of calm.
Right.
Or what to do in the face of not being calm.
Whatever the storm is, whether it's, a huge tailwind trying to push everything forward or whether there's a gale force wind coming straight at you. People are always looking for, that the confidence and the self-assurance of like, hey, let's do the right thing. Unfortunately, like 95% of the time, doing the right thing is really, really, really boring. And so like hearing somebody say the same thing over and over again, like gets monotonous, even though it's the right thing to do.
Yeah, and I posted on LinkedIn and Instagram today about this very topic, and it was about media and wanting to get your eyeballs and focusing on what actually matters instead. And that's talk. And I listed several things. It's making sure your balance sheet is set up in a way that everything is not invested in the market, right? Everything doesn't rely upon that market. Having the flexibility on your
Look,
balance sheet.
and pause for a second. How do we define the market? Like, so much right now is focused on the S&P 500 as the market. And that, like when I was in school, that was how it was taught, was the S&P 500 is the market. Well, but that's only the largest 500 companies in America. Like that's not the full market. And right now we're sitting in relatively unprecedented territory where the top 10 stocks in the S&P 500 are 30, 33, 35, 40%, depending upon how exactly you break it down and what's going on that particular day.
Yep.
Like that, you're not looking at the market anymore. You're looking at just a few stocks. It used to be that people thought of the market as the Dow Jones. And like one of the things that I used to ask people is, well, how many stocks are in the Dow Jones? And nobody knew.
Right.
The answer is 30.
Yeah, and again, this goes back to the talking heads because they
Mhm.
use S&P 500. They use right, and that's the main one that they utilize nowadays. But they used to say Dow. They used to say these things, and I think when people hear that word Dow or the S&P 500, they don't correlate it with, oh, that's just 500 companies in the U.S. There's this thing called Earth, and there are some quite large international companies. There are smaller companies, right? Like it's not just US based only. And if they looked at last year's returns, they would see, oh, international small did really well. Emerging markets did really well. It beat the S&P. Now, caveat, I'm not telling you to go put money in those asset classes. I'm just sharing with you this is
Which
another thing that matters is making sure when you're invested, make sure you're not over concentrated.
chances are you should have something allocated to those markets. Ma- Like, don't go throw like 80% in any of those.
Yep.
Just like you shouldn't have 80% in the S&P 500 or like whatever. Like, have a diversified portfolio. Uh, and it's just uh, the amount of conversations that we have with people that where they're like, "Oh, well, I've got like 4 different index funds." And we run the numbers and we're like, "Yeah, like 50% of your wealth is in 10 companies." And they're like, "What?" Yeah.
Yep.
People just don't understand how to drill down on a lot of this stuff and what it actually means and like how to actually like interpret what some of this stuff is and means. And then we also like deal a lot with trying to time the market and make predictions. And we're living in the information age where like at one point it was super expensive to get real estate really close to the stock market so that you could get like execution on trades nanoseconds faster.
Yeah.
Like that's how quickly stuff changes these days.
Yeah. So when we put all this together, right, something that's important to do is to zoom out,
Hmm.
right? Because that's when you can look at like the bigger picture and not just focused on February 2nd, 2026 and what may or may not happen today. Because I hate to break it to you, for those who are retired, they'll also tell you this. You still have money invested in retirement. It's not
What?
like you get to retirement and you don't have any money invested, at least most people, right?
Well, I
So
mean, heck, back in the 80s, like you could just throw all the money in the CD and like you can't do
you
that
could
these
go
days.
find a 6 or 7 or 8% CD.
Oh,
Yeah, very
12,
different.
13.
So, like, we were asked a question the other day in a client meeting, and the question was, "Hey, what do you think about the market being overvalued?" And my question back to them was, "Overvalued compared to what?"
Which was a brilliant question. And like the client literally just stopped dead, thought about their question, and was like, huh, like I believe their response was something to the effect of, you know what, you're right. It doesn't matter so much where the market's at right now. We care about where the market's going to be in 15 to 20 years.
And so it's again, a lot of questions that we get, oftentimes it's something that they heard from either someone they were talking to, or maybe something they read or heard on social media. And so, like, we're looking at the S&P 500 here on Yahoo. This is again, February 2nd. And I'm not showing this to say we're only focusing on the S&P. This is me focusing on zooming out, right?
It's designed to be a look at a relatively well-known index that is a conglomeration of multiple stocks.
So if we start looking at this, right, we've got right here is 2000. This very question was maybe being asked at that time, and then '01 occurs and it starts to go down. So in theory, I guess it was overvalued here. But if you zoomed out, would you have predicted that it would come back? And then again, it goes down in '08, and now look what it's done here. So again, my question to you is overvalued compared to what?
Well, and like, so Ryan, highlight say 2005 and then like look at 2008 or sorry, not 8, 7. That's 29 or 2009. So, all right, there. So, like, okay, we're talking about being up 662% versus go back to '05, 566%. Yes, there is a statistical difference there. However, purchasing was the critical decision. Like whether you got in '05 or '07, it, yes, there's a difference there. And you're being rewarded in this example for like having more time. Like there's plenty of examples where like if you highlight 2000 versus 2002, like, okay, up 660 or 654% versus go to '02, somewhere in there. Yeah. 574. Like, yes, there's a difference there. And you were rewarded in like over time by like waiting. But at the same time, like the difference is not that big. Like we're, um,
And this
you
is
know,
just us picking on the S&P 500. Again, you should be diversified. And our approach is we do a global diversification, right? And we look at all of those pieces. And when you put that in, like we analyze our clients, or I go back and I show them, hey, this is what you look like 5 years ago. This is what you look like now. This is what you look like 10 years ago. This is what you look like now. And so even if the market was down 10% today, which it's not, but let's just say it was, you're still up and up big on your balance sheet. And this is what you should be looking at. You should be zooming out. You should not be worried about February 2nd, 2026. And if you are, meaning you're about to retire and you're genuinely worried about the market being down so you can or cannot retire, you've got bigger problems. You need to be having a conversation with someone to diversify, or at least maybe check how you're setting yourself up to turn on the income stream.
well, and most of the time we recommend our clients start this process of deleveraging some of their risk between 5 and 10 years from retirement. And there are 3 or 4, maybe even 5 main ways to go ahead and accomplish this. Everyone's situation is unique. Build the circumstance, like build the strategy that works best for you. And that's going to depend on where you're at, where you want to go, and like a whole host of other issues. I mean, that's where a financial advisor, financial planner can really do a lot of good work for you, is in helping you get to a point where you're moving from accumulation to distribution. That, call it 15-year window, like the 5 to 10 years before and the 5 to 10 years after, is really where the lion's share of value that's being driven by a financial advisor comes from. Can we help people outside of that? Absolutely. The sooner that you get started working with a planner, whether it's us or somebody else, the better off you're going to be. And there is, like, I can't tell you how many times I have heard clients say, "Oh my God, thank you. Where were you 10 years ago?"
Yep.
Or, "Can we go back 10 years and have this conversation then?" Sorry, we can't.
So to have this reassurance, right? Being able to stay invested because you've set up your balance sheet appropriately, making sure your balance sheet is flexible, and making sure that all of this is staying aligned with your personal goals, not someone else's goals, right?
Or somebody else's strategy. Like, you have to
Most like
understand it.
Yeah, and if you set up your balance sheet appropriately, most likely this year is not going to make or break you, and
It
that's a
shouldn't.
good thing.
Yeah.
So I'd like to just end it on this. Predictions are loud. Planning is quiet.
I've heard that before, but man, that it's so impactful.
So hopefully this episode is valuable for you, right? Head over to builtforlife.notjustwealth.com, and there's a contact us there for you to answer any questions, or send us questions, not answer the questions, but send us questions. Or if you have a topic that you want us to talk about, that's a great spot to reach out to us. There's other episodes on that website. So we record once every week. And the whole purpose of this podcast is to help you think differently about your money to fulfill your goals, and not allow all of this trash that's out there. And by trash, I mean noise, to derail what you want.
100%.
So we hope this episode is valuable for you. And Mr. Collins,
Make it a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
875-7298.1, expiration date February 2028.